Our guest today has spent the past 35 years analyzing current events to forecast the future. He's also the publisher of the Trend Journal and says 2015 will be great for gold, not so much for equities. Gerald Celente, thanks so much for being on the program.
Thank you.
Gerald, let's start with some comments you made on the US dollar and gold. You recently said that QE has morphed, not ended. What do you make of the recent dollar strength we're seeing, and how is that connected to the alleged gold manipulation that you write about?
Well, the dollar's strength is really many of the other currencies' weaknesses. There's nothing there to bolster the strength of the dollar, particularly when you hear the Federal Reserve, as the markets began to go down in October, they came out and they used some cryptic language to indicate that they were going to keep interest rates low for maybe longer than when they said they were going to raise them. And now they're saying that they may not raise them until 2016. That will mean that they haven't raised interest rates in 10 years if they wait that long, because they haven't raised them since 2006. There's nothing to stabilize the dollar's strength. We're not seeing it in manufacturing. We're not seeing it in production. And then when we just saw the latest unemployment numbers that came out, yeah, they created more jobs, but wages went down. I have never been a proponent that gold prices will go up because inflation will go up. What's going to drive up the price of gold is the value of the currencies are going to continue to decline. Look what's going to happen over in Europe at the end of this month. They're going to have a meeting for, quote, quantitative easing. That means buying up junk bonds, and they're even talking now about buying up junk corporate bonds. So it's one grand manipulation.
So given our current market conditions, what should the price of gold be, Gerald?
Oh, gold should be over $2,000 an ounce. And by the way, I've been buying gold a long time. I began buying it in the late 1970s. Matter of fact, I bought gold on the day when it hit the intraday high of $875 in January of 1980. And I woke up the next morning and I lost about, a third of everything that I had earned. So I was there in the first gold bull run. This is a very different world than it was back then. You're seeing demand in China. You're seeing physical demand from India. You're seeing physical demand everywhere that didn't exist back then. So this is a very different marketplace. Again, the only reason why we see gold prices being suppressed because it is not in the best interests of the central banks to wake up the people that are saying, look, we've been printing all of this digital money backed by nothing, printed on nothing, and it's not worth much, and that's why gold prices are high. They don't want that to happen. They will do everything and anything to keep the prices low.
Gerald, let's look at the term bankism, which you say has replaced capitalism. Tell us a little bit about this term and how big banks are profiting more than the regular investors in the stock market.
4 words killed capitalism, and they're undeniable. Too big to fail. Those words do not exist in capitalism. Period, paragraph. Nobody's too big to fail, except if you're one of the big banks. It's a banking takeover. Now we have a situation where the Fed's loaning out money at what? To the big guys, 0.25%. How does it benefit the market? So here you are. You're one of the big bankers. I got a deal for you. I'll loan you this money out at basically nothing. And you could loan it out and get any price that you could get for it because we just wiped out the usury laws over the last 30 years. Number 2, one of the big guys of the Fortune 500, buy back your stock. We're going to keep that market up. Number 3, mergers and acquisitions. You get your money cheap and start doing deals again. And now we're back in 2014 to 2007 levels of mergers and acquisitions. Now, how does it hurt the average person? Once upon a time, when I was a young man, they used to have a thing called savings accounts. That's right. People put their money in the bank and they got interest in return. And that interest was higher than the rate of inflation. Now you put your money in the bank, well, you get virtually nothing back because interest rates are so low, it's only benefiting the bigs. And if you live in Europe and you have a certain amount of euros going into the bank, guess what? You have to pay them to keep it there. So that's the deal. It's only helping the big. That's all that's juiced this stock market is the quantitative easing, record low interest rates, and funneling money. And it's not to the 1%. It's the 0.01%, just to make the point.
Gerald, deflation seems to be a main concern right now. How do you see it playing out in 2015?
Well, again, they're calling it deflation because in that white shoe proper language boys school, they won't call it depression. That's what this is. It's not deflation. Prices are being depressed because it goes back to what I was just talking about. Not enough people have enough money. And so the money's all concentrated in the hands of the few. So when you're looking at oil prices, and we've been on top of this, when they hit $115 a barrel in June and the prices started to go down, our radar went up. What's going on over here? Is the height of the driving season, why are prices going down? It's not only oil prices that are down, you have copper prices down to over 5-year lows. Why? Well, China consumes about 40% of new copper production. So what we're looking at, this is not deflation, it is a depression. People cannot afford to buy products. That's what happens in a depression. And they're coming out with this sick thought, Daniela, that deflation is bad. You know why, little boys and girls? Because if people know that prices are going to go down, then they're not going to go out and spend money. What a load of garbage that is.
Gerald, I guess to wrap, any final thoughts for investors as we enter 2015, the year of rate normalization?
Well, of course, we don't give investment advice. We're trend forecasters. But you go look at yesterday's market. Look how it was up 282 points and shoo, wham, bam, it's knocked down. Even with the grand manipulation, they cannot keep these markets going. The new year has started on a down note. And now you're seeing gold, moving well above that 1,200 mark for the time being. So we think the bottom is already here. We believe this is a good year for gold and not a very good year for the equity markets. We may see the panic of 15 before too long in the equity markets.
Gerald, that's all the time we have today. Thanks so much for joining us.
Thank you, Daniela.
And thanks for watching this edition of Kitco News. You can email us comments and questions at newsfeedback@kitco.com. We'll see you tomorrow.